tax season is right around the corner, and if you lost money in crypto last year, I have some pretty good news for you. Welcome to Whiteboard Crypto, the #1 YouTube channel for crypto education. Here, we explain topics of the cryptocurrency world using analogies, stories, and examples so that anyone can easily understand them. In this video, I'm going to be showing you how I file my crypto taxes, and specifically what you can do to save money if you maybe lost money on crypto last year, either through it being a vicious bear market, or if you lost money due to scams, rug pulls, or even the FTX fiasco. Now, before I start, this video is not intended to be financial or tax advice, but it should help point you in the right direction and teach you the things that you might not already know that could eventually save you money when preparing and paying your taxes. Now, the first thing we should discuss when it comes to crypto taxes is something called capital gains and capital losses. These are technical terms to describe your trades, depending on if those trades made money or lost money. This applies to anything you buy or sell, whether that be houses, cars, watches, stocks, and in our case, crypto. So let's say you bought a Bitcoin for $20,000 and then you sold it for $30,000. That means you would have a capital gain of $10,000. Let's also say that you bought the same Bitcoin for $20,000 and then a little bit later you sold it for $15,000. Well, that would mean that you have a capital loss of $5,000. This is an important distinction because if we make any gains at all, we'll have to use them to calculate how much money we owe to the government in the form of taxes. Technically, we can use our losses as well, but we'll get to that in a second. Another thing worth noting here is that there are actually two types of gains and losses, long-term and short-term. And to be simple, long-term is for a gain or a loss where the time difference between the two trades is more than a year. On the other hand, short-term includes trades that are less than a year. Now, as you can imagine, our US tax code favors long-term holding. In other words, you pay less taxes on your gains if you hold your coins or tokens for more than a year. Now, the max tax rate of long-term capital gains is 20%, while the max tax rate of short-term capital gains is a whopping 37%. So quite a big difference. Sometimes, holding your crypto for just a few more months to save on those capital gain taxes can make sense. So much so that since the difference between 20% and 37% is almost double, some people keep the year timeline in mind when looking at technical analysis. Alright, so we kind of went over trades. What about crypto income? All of the income that you gain from crypto, whether it be from staking your coins, yield farming, or even getting an airdrop, it must be recorded as income on your taxes. This income counts as ordinary income, which is technically the same category as money that you earned from a job, and because of that, it falls under the same tax brackets as short-term capital gains. This means it's taxed at a higher rate, especially if you made a lot of money during the year that you received that crypto income. So your crypto income is added to your ordinary income to calculate your tax rate. So let's run through an example and say that you earned $50,000 from your W-2 job, and then you earned an extra $20,000 from yield farming. This brings your total to $70,000. Now, if we assume no deductions, let's see how much money in taxes you would have to pay on that federally. So first off, you get an automatic $13,850 standard deduction if you choose it. And for this example, we're going to be choosing it. The government basically says the first $13,850 that you earn is all yours, so you don't have to pay any taxes on it. This automatically brings our taxable income down to $56,150. Now, here's a quick chart of the federal tax brackets, and they work like buckets, where you fill the first bucket up and you pay the tax rate on that bucket for all the money inside of it. And then whatever is left over, you move into the next bucket and you pay the tax rate declared on that bucket, and so on until you run out of money to keep moving into future buckets. So in our case, the first bucket holds $11,000 and the tax rate is 10%. So we completely fill that bucket up and we take 10% of $11,000 and we get $1,100 and we add that to our tax bill. Now we subtract $11,000 from our total taxable amount, $56,150, to get a remaining taxable income of $45,150, which we take and put into our next bucket. This bucket holds $33,725 and is taxed at an increased 12%. So, since we still have around $45,000 left of taxable income, we actually completely fill this bucket, and because of that, the math is easy. We take $33,725, which is what this bucket holds, and multiply it by the tax rate of this bucket, which is 12%, to get $4,047, which is added to our tax bill. Now, we can take $45,150 that we started with and subtract the $33,725 that we just put into bucket 2 to get a remaining taxable amount of $11,425, which goes into the next bucket. Now, we don't actually fill the third bucket up, but we do place all of our remaining $11,425 into it, and this bucket is taxed at a much higher percentage of 22%. So the $11,425 that are in it is taxed at 22%, which will come out to $2,513.50, which we then add to our tax bill. And since we didn't fill this last bucket up, we can stop on our calculations since we've calculated our total tax bill. Now, all we need to do is add the tax bills from the buckets up. So $1,100 from the first bucket, $4,047 from the second bucket, and $2,513.50 from the third bucket. All of these together equal $7,660.50, which is the grand total that we owe to the federal government in this example. Again, this is a very rough example to explain how a progressive tax system works and to show you that you're incentivized to lower your taxable income to save on paying taxes. If we lower our taxable income, the money that we remove from it actually comes out of the 22% bucket first. And remember, this doesn't count self-employment tax, deductions, or state income tax, so remember to talk to your accountant about more specific tax advice. Moving on, let's learn how to offset our income. So since we already know that we're incentivized to lower our effective tax bracket to reduce the amount of money that we pay to the government, I'm going to share with you some legal ways to reduce your taxable income. Number 1. Traditional IRA. Now, a traditional IRA is an individual retirement account that you can open for yourself and contribute up to $6,500 per year. Unless you're over 50, then it's a little bit more. Anyways, this is how an IRA works, is that you deposit $6,500 and then you can simply reduce your taxable income this year by $6,500, lowering your overall tax bill, or rather the money that gets put into those taxable buckets. Now, it is important to know that this account is for retirement, so the money can be withdrawn before you're 59 and a half, but you'll also be paying a 10% penalty, plus the $6,500 or whatever you take out will be added to your income that year. So you're effectively moving the tax bill that you pay on the $6,500 from this year to a year when you're in retirement, which the goal is that when you're in retirement, your income will be lower, so your tax bracket will be lower. Last year, my wife and I both contributed $6,000 each, meaning a total reduction of $12,000. Next up is a traditional 401k or a solo 401k. So a traditional 401k is very similar to an IRA, except the limits are much higher, and sometimes your employer will even match what you contribute. Now, I don't have an employer, so I have what's called a solo 401k. And last year I contributed $60,000 to reduce my taxable income by a whopping 60 grand. Which saved me a ton in taxes and also gave me a nice retirement cushion, which comes in handy being in the crypto space. Next up, we have an HSA. So an HSA works very similar to an IRA and a 401k, except that the funds can only be used on qualified medical expenses. HSA actually stands for Health Savings Account, and it isn't available to everyone, only to those whose insurance offers it. Because of this, I actually didn't contribute to an HSA. Number 4 is charity. So any money that you give to a charity or a nonprofit, which can technically be proven with a receipt, can be used as a deduction to reduce your taxes as well. There are charity DAOs out there which could technically be used to lower your tax bill while benefiting society. Number 5 is to deduct any money that you spent to earn crypto. If you run your crypto income like a business, then technically you can write off any expenses related to making crypto money. For example, last year I mined Ethereum and I wrote off the $4,000 mining equipment that I bought, as well as the increase in my electricity bill. This isn't something you should take lightly though, as you should definitely talk to a professional accountant about the correct way to deduct these. So the past 5 methods have been ways to reduce your income specifically, but there's another way you can reduce your capital gains as well. Let's say that you got lucky and earned $40,000 from a good Mooncoin bet in early 2022. This means that you're going to have to pay taxes on that $40,000 if you sold, and since it's a short-term capital gain, you'll be paying a decent chunk in taxes. Well, let's say you lost about $5,000 in a crypto scam, you lost another 10 grand in FTX, and maybe another 12,000 from trades that just lost you money. That totals $27,000 of losses. You can actually take these losses and add them to your gain to reduce your real gain or your profit to $13,000, which will lead to a much lower tax bill than a profit of $40,000. And finally, number 7 is that you can carry over losses from last year. So let's create another scenario where you still sold your $40,000 moonshot of profit, but you also lost $100,000 in the FTX fiasco. Does this mean you can write off 60 grand that you lost? Meaning maybe the government will owe you money? Well, not really. You can only claim $3,000 of losses in a single year. So if you really did earn $40,000 and then lose $100,000, then you could only claim $3,000 of losses this year. Next year though, let's say you earn another $40,000 from another moonshot. Well, you can apply your remaining losses to that capital gain. So for in this example, last year you had $60,000 of losses and you used $3,000 of that last tax year. This means you still have $57,000 of losses from last year that you haven't used up yet, and you can carry those over to this year, meaning even your $40,000 of gains minus your $57,000 of losses last year still nets you negative $17,000 of losses. And since this is way more than $3,000, we can only claim $3,000 this year and then carry over $14,000 for next year. That was a complicated example. Let's get into something a little more interesting. So now that we've gone over what capital gains are, the fact that you do have to report your trades and income, and some ways we can actually lower our taxable income, how do we actually do all of that stuff? Isn't it super complicated to go through and count the gains and losses of your trades one by one? Well, I'm glad you asked. This video is sponsored by CoinLedger, which is a tool that I've actually been using for 2 years to prepare my tax paperwork when it comes to crypto. So literally what you do is you import your exchange accounts that you've been trading on. You can give them your wallet addresses if you want to, push a button, they do the math, and then basically they let you download a file that you can give to your accountant or even upload to TurboTax that basically automated all your crypto tax stuff. I want to show you what I actually do here, so let's walk through it together. Alright, let's get into using this software. So I'm actually already logged in and I've already purchased a report. So what I'm going to do next is actually add my accounts. So I'm going to go ahead and click Add Account, and the first thing I'm going to be adding is Coinbase Pro. So I see Coinbase Pro here, I'm going to select it, and instead of uploading a file, I'm actually going to be auto-importing it using an API key that I've already set up. So I've copied and pasted those here. I'm going to go ahead and click Sync Transaction, and this is actually going to communicate with Coinbase Pro to go and grab all of my transactions and move them over. And before I get any further, I do want to say that this is a test account. This isn't my real Coinbase Pro account or any of the future information that I input into this, just to show you how it works. So now the next thing I'm going to do while that's auto importing is I'm going to add another account, and this one's actually going to be MetaMask. So MetaMask, we find it, and we can click Sync Wallet here to basically input the address that I want to sync with my taxes. So I'm going to go ahead and put an address in here. It is on the Ethereum network. I'm going to go ahead and click Sync Transactions, and this is actually going to grab all of the blockchain transactions that I've made with this account. So I'm going to go ahead and click Looks Good, and you can actually see back in 2020, 2021, there was a bunch of transactions here. You can also see the name of these: add liquidity, remove liquidity, a fee. What I really like about this is how automatic it did all of this. So I don't have to type any of this stuff in. And finally, while Coinbase Pro is still loading, I'm going to show you how to do manual imports. So for here, I've got income. So this would be income that I received through something that isn't able to be automatically applied through their software. For example, maybe on August 1st, I received 50 secret tokens just from staking. So I can fill out this spreadsheet here. And if I wanted to, I could just continue on down and add more things to the spreadsheet of this income. So I'm going to go ahead and File, Download, and download as a CSV. Now the next tab of this is swaps. So maybe I made a swap on something that MetaMask wasn't able to detect. Well, I can actually manually input them into this file as well. So we've got the date here, the platform, which is optional, what I gave them, which was 5 SOL, and then what I received, which was 127 step-in tokens. And then I just say what type it is. It's a trade. And I make a little note for myself here that I was buying step-in. And this is an example of swaps, of using manual swaps to import. And there's another tab down here called Losses, which is where I'm going to be reporting losses. I would report rug pulls here, the FTX fiasco, the money lost in the FTX. This is where I would report it. And I would basically say that I sent them AVAX 17.21 and I received $0 back. And then I just report it as a theft loss from the platform FTX. And so I'm going to go ahead and file, download this as a CSV file as well. And so now we've got our 3 files here, and I'm going to import them into CoinLedger. It looks like Coinbase Pro did successfully get imported, so we can click Look Good, and we can actually see all of our transactions from Coinbase Pro. But next, let's add in those manual ones that I just created. If I click Add Account here and I scroll all the way down to the bottom, there is Other Account. So I'm going to go ahead and click Other Account, and then where it says Upload File, I'm going to drag and drop this first one into it. And it's going to make me confirm that SCRT is this actual secret token here so that I can sync with my other transactions to know it's the same coin. I'm going to click looks good. I'm going to upload another file. This is going to be my second one. One transaction has been imported, and you can see that one was actually the SOL to the GMT token. And finally, I'm going to upload the last one, which is when I lost money on FTX. You can see here, it looks like a sell of 17 AVAX for $0, but that's just the way that I'm going to report it to simulate losing money on FTX. So now that we have all of our info in here, and of course, if you have Binance accounts, BlockFi account, Gemini, Kraken, KuCoin, any of these exchanges, it's as easy as setting up your API key, copying and pasting it over, and then they do the rest. It makes it super easy. The same with this spreadsheet. I personally keep a spreadsheet of all of my transactions, so I just have to basically do a little bit of clicking and dragging and dropping to get it into the format that they want so that I can then download it and import to their software. So once I'm happy with importing all of these accounts and they are all done successfully, I can then go over to the review section. Now this is actually a list of all the imported transactions. You can see here there's 1 to review, and if I hover over it, it says it's missing cost basis. Now this is basically a technical term that says the software doesn't know where you got this 497 USDC, and if it doesn't know, it's going to assume that you paid the current full price for them. You can see that this is yellow, which means it's a warning and not an error. I have gotten errors before, and those are pretty simple to fix. But since this is just a warning, and I don't mind about paying the tax on $500 of USDC, I'm going to go ahead and just click this tax report button here. Now, since I've already purchased a tax report, you can see here 2022 tax report, along with all the information of my transactions. You can see in 2022, for the information that I imported, the short-term capital gains was $2,015 with 33 cents. The long-term capital gains was $400. You can see both of these are red with a negative mark. It means that they were capital losses, and the total of that is $2,415. If I wanted to, I could actually click on these, see the date that I bought this specific Bitcoin here, see the date that I sold them, which makes them long-term because this was more than a year, the amount that I bought it for, the amount that I sold it for, which includes the amount of the gain or the loss. Now, most of this here is actually because of this AVAX here, this $500 worth of AVAX, which is technically included in what I listed to be lost by FTX. So if we go back here, another interesting thing is you can also look at your end of year position, which shows you basically how much crypto you currently have and the remaining cost basis of that. Now on the other side of capital gains, you can also see over here there is taxable income, which right here in this simulation I've only added staking income. So I can go ahead and click on this and see the staking income was 50 secret tokens, which was actually what I added here in the spreadsheet, 50 staking tokens, and they automatically calculated it as $53 of income because the price of secret at the time was $1.08. So that's cool and all to see those numbers, but what is really helpful? Well, if I go over here to IRS forms, you can actually see I can actually generate and then download these forms. So I'm going to show you 2 of them. The first one is going to be Schedule D, and the second one's going to be 8949. So if I download Schedule D and I bring it up here so we can look at it, you'll see that it is literally an IRS form pre-filled with my information. I just had to print this off and give it to my tax accountant. It's the same thing for this form 8949. If I go ahead and download it, this is actually a form that shows every single one of my transactions to the IRS. Usually, this would take hours to complete by hand, so I highly encourage you to use software. Again, I just hand this to my accountant, they smile, and thank me. Maybe you don't use an accountant though. There is this tax filing software right here you can click on. Maybe use TurboTax or TaxSlayer or H&R Block. You can actually download forms that you can then just upload to those software that you use. So overall, I really like this software. I love this software. It saves me so much time, and I can trust that there's no issues in my tax reporting for my cryptocurrency trades and income. If you want to test this software out, it's actually very affordable for tax software. There's a link in the description below you can click to get started. Now this software is called CoinLedger. Previously they were named CryptoTrader.tax, but they rebranded to CoinLedger. And they keep making improvements, and I couldn't be happier to be sponsored by a software that I actually use and love. Now before we go, there is one more thing I wanted to show you. If you're up to date to the current year, for example 2023, we can scroll down here and they actually have a tax loss harvesting tab where you can basically sort your cryptocurrency by the most amount of money that you've lost so far so that you could sell it and then buy it back to essentially increase your losses. This is kind of an advanced tax strategy and they make it super simple. Anyways, thanks for watching. I hope you liked this video. I really hope you learned something. And most of all, I hope to see you in the next video.